All right. Good morning, everybody. We made it. So the anticipation for the week was that we were going to remain range bound and sideways until the CPI day. And that's what we got. It's nice when things actually work, even in this chaotic market. So we had a lot of Fed speakers yesterday, and we had Yellen also out chipping her teeth because, didn't want to be outdone. There's still a really wide gap between what the Fed is saying and what the market is pricing in when it comes to the target Fed funds rate and whether or not they're going to pause or if they're even going to cut this year. And right now, earnings estimate revisions and the momentum of those revisions are a really big deal. I'm seeing a lot of that. Everybody's trying to figure out what's going on without the Fed, right? So it's causing a lot of you know, yeah, confusion, I guess, is just a really good word for it. It's just a whole lot of confusion out there. We're going to get FOMC meeting minutes today as well. It's from the last FOMC. We have 21 days until the next FOMC, which is May 3rd. And right now they're pricing in a 25 basis point rate hike for May. Nothing for June. And right now, for the July FOMC, they're actually starting to price in a rate cut. Even though the Fed has continued to say we're not going to cut rates this year. And if you listen to everybody who's out talking right now, the economy's strong, the financial sector bounced back just fine. It was an isolated liquidity incident. Nothing to see here. Everything's great. So if everything's great, they're not going to cut because they have no reason to cut, right? They're going to cut if there is a crisis. And according to everybody, there is no crisis. There's no recession. We've got, strong economic data and green light is go. So why would they cut? They won't. So something is wrong here in all of this data. If the market is pricing at a cut, it's because the market believes there's going to be a need for a cut. There is talk of a looming recession. It's not anymore a discussion of if there will be a recession, but when there will be a recession. And if you continue to click through this and get, say, into the fourth quarter, it really starts pricing in, a deeper cut. So today we got the 10-year. That's going to be a really big deal as well. It's just a full house of data points. And keep in mind that tomorrow we also have PPI. So it's going to be a busy day tomorrow too. Here's your spot gamma levels. If you want to grab a screenshot of that. All right, so we got a lot of speakers again today, and we have crude inventories at 10:30. So, if you wanted to keep your eye on something like USO, um, still very often gets sympathy in these moves. So you could look at, X steel or something similar. Apparently, this new Fed guy, good whatever his name, good something. He was speaking yesterday, and he was considered to be the most dovish sounding Fed speaker out of the entire bunch. He really seemed to be leaning on the idea that they need to pause and get into a defensive crouch, basically a wait and see, and let things kind of digest a little bit. So we'll see if these other Fed speakers today try to walk that back or embrace that a little bit. Remember, we want to see them singing from the same book, right? So the volume is really light this morning, and this is normal. It's what we expect, right? When there's something looming on the horizon, nobody's going to get in. They're going to sit out and wait, and then get the data that they're looking for, and then make a decision, and then get in. That makes sense. So light volume, if we saw something this light and we didn't have something on the agenda, then I would be concerned. But since we already know it's CPI day and the investors are waiting, this low volume isn't concerning. We just take that off the table. So these spot gamma levels, real quick, I've started adding it to the morning briefing because they do provide some insight. Right? There's a company called Spot Gamma. Spot Gamma uses these complex algorithms to peruse through the options data, whether it's the deltas, the gammas, everything that they've got, including liquidity, transactions through the JP Morgan spread, and every single thing that they have, and they come up with these levels. Now they're going to do a much better job explaining what these levels are than I'm going to do. But if you were just to say go to Spot Gamma, and if you look them up on YouTube, they've got a lot of great tools, a lot of great insight. And while it's not free, it's why I show those levels every day. Those levels are also imported into Trade-O-Bate. So here where it says 0 gamma, large gamma 3, volatility trigger, I import that data every day by hand in here into this indicator. It gets posted right there. So this is a tool that you have to pay for, but I stop every morning, let you get that screenshot so that you'll have those levels. There is another place that is free, Tier 1 Alpha. I think you're better off going to Twitter to catch their email address, but they'll send you an email every morning with a nice little write-up and with their own levels, which sometimes match Spot Gammas and sometimes they don't. But Tier 1 Alpha has some really, really great content, and it's free. I mean, you gotta love free. So these levels, I just stop the screen like that. You can take a screenshot, then you can mark them out on your chart for the day. One side is the ES, the numbers in the middle. The other side is the SPX, which is the numbers on the left. They do offer it for the NASDAQ, the Russell, the SPY. I just focus on this one. All right, for tier 1 alpha, this is their blog. I guess it's the old ones. I'm going to post that into the chat on this video. You can see if you go to YouTube, or not YouTube, but Twitter, you'll be able to find these guys really easy. Tier 1 alpha, really great content, including those gamma levels, volatility bands, and that includes everything: SPY, the Qs, Apple, Facebook, Amazon, the FANGs, the NASDAQ, with a really good write-up too. These guys always have some insight that is really great for the trading day. I like free. Free is good. All right, so all these data points today are big ones. Every one of them, including the inflation expectations at 10 o'clock. It's a big deal. So all day today, if we get bared up, or if we get bullish at the open here at 8:30 with the CPI report, at any point today, at any one of these hourly markers, we could flip over and head the other direction. Because any one of these could contradict the data that the market is already fighting with. And one thing that stands out is the CPI data that we're expecting to get today isn't actually going to give investors and traders the insight they're looking for. It's not the clarity that's going to wipe away this fog and confusion. So sure, it's an important data point, but it's not going to actually give us actionable intelligence, right? We can't use it for, say, the next 3 months or the next 2 months, which is possibly why we haven't seen, or I haven't seen, too many indications that we're going to make this really big outsized move. We haven't been hearing about a big outsized move. And while I haven't read Tier 1 Alpha today or Spot Gamma's founders notes yet, it sure doesn't look like the market's pricing in a big move either. We'll be able to see that in the options volatility and in the options volume. So if they're pricing in a big move, we should have seen it. Now, one thing about that big move, we can see that there is the potential for a big move because we have a market maker move today. Just the fact that we have that market maker move sitting there tells us the market is anticipating a little bit of volatility. Now, I turned it into a label, but it's also on the options chain right up here at the top. Market maker move is exclusive to the Thinkorswim platform. They made it up. It's just a phrase that they came up with a long time ago to distinguish or identify when the front end has a higher average implied volatility than the back end. That's it. That's all that it is. And they use that in a variety of ways. And if you wanted to read more about it, you could go to TD Ameritrade's publication site. It's called The Ticker Tape. Everything that I've ever learned about Thinkorswim has come from reading articles on that site. Absolutely amazing content. And it's all related to the market and or Thinkorswim or both. And I mention that because I've heard some really smart people who have been in this industry for a long time talk about the market maker move and tell people things about it that are just completely not true. It's like they have some vague idea and they're just filling in the blanks with their own crap. I don't know why. It's not my issue on why. But don't take my word for it. Go read about it, right? It's well-written material. All right, so we had a very narrow IB last night. The IB being the initial balance. Think of it as a 1 hour open range. Really narrow right up until the kill zone. Between 2 and 4 a.m. is what they call the kill zone. I didn't name it. I probably would have come up with something that had the name cookies in it. Maybe it wouldn't sound so violent, but that's the kill zone between 2 and 4 a.m. Historically speaking, you'll get bigger moves in the kill zone than you will at any other point in a 2 hour period through the entire trading day. So bigger than the open, bigger than power hour. The biggest moves in the market happen between 2 and 4 in the morning, statistically. I don't get up to trade it at 2 in the morning, but I can tell you a lot of times I've traded the gap close from it, a liquidity gap. So when price moves really fast, kind of like what we had here yesterday afternoon, this creates a liquidity vacuum. And then what happens a lot of times, we'll spend the rest of the period working our way back up to that liquidity gap, getting it filled before dropping right back out of it again. I get into the office around 5 Eastern. And usually I miss the kill zone move. But if it's a really big move and it creates a liquidity gap, by the time the gap gets reset, it's usually right when I get into the office, which gives me a nice play, get my day done early. Speaking of that liquidity gap, it's on the table for today. Every time we have one of these CPI, PPI pre-market mornings, we have the potential for this really great setup. I'm going to talk about the idea of a gap, but there is no candle gap, right? We're talking about liquidity. So you'll see candles there. I've had people that continue to reach out and say, what gap? I don't see a gap. I see candles. Yeah, there's candles. But we have to call it something. And liquidity gap is what it's referred to. So I'm scrolling back here looking for examples. History doesn't repeat, but it sure does rhyme. And what we're looking for is a day where we had a pre-market economic data point come out and a lot of volatility. This isn't the greatest example because we got volatility in both directions, but this creates a liquidity vacuum and price will work its way back up and close that vacuum. If we were to keep going, say to December 13 or November 13, either one of those, there's the 20th. That must have been PPI right before a CPI. That'll work. All right, so this is where we left. Data point came out. We shot up really hard, really fast. This created a liquidity vacuum. It is the gap that I'm talking about. So, no candle there at all. Consider that a big gap. And the market spent the rest of the day coming back down and closing that gap. It actually overshot the gap a little bit. but it wasn't hard to tell where we were going. Now, this might be considered a one-off, like, oh yeah, man, you even knew what day it was. You've seen it before. Yep, I've seen it before. But that was December 12 CPI, and you could go to, November 12 or November 13 CPI, and you'd find the same thing, a really big move, and then the market working its way all the way back to where that big move started. So it's not a one-off. It happens way more than you realize, especially if it's never been pointed out to you. But now it's been pointed out, so you can go hunting for it. There's always a fake out, right? There's those times where we're going to get this really big move and you think, oh, big move, liquidity gap. We're going to run back up there and close that gap. And it just keeps going farther away because the market doesn't always do something, right? The only promise of always is that it'll take your money if you lower your guard just a little bit. It's going to rob you. It's the only always that I know. But we're looking for an 830 data point that gives us a really big move in the market, preferably clean, like that December one that I showed you. One direction, big move, and then it resets through the rest of the day trying to close that big move. So here was another one. This is the November CPI, PPI pre-market. So it got the data point, set a really sharp high, spent the rest of the day trying to get back to that data point. And when it finally got there, big dump. And then, of course, that created a liquidity vacuum, and we spent the rest of the afternoon working our way back up to that data point. Like a twofer. So this is on the table today. We don't get these all the time. I don't know that we're going to definitively get one today, but it's absolutely possible that we get one of these today, and kind of expected. The first one that I tried to show that wasn't very good, that's what we don't want to see today. We don't want this to give us a really wide, big move to the upside, and then also a really big, wide move to the downside with these massive candles in each direction. That's not going to be helpful or useful, right? We want one direction. So it drops hard to the downside, 30, 40 points, and spends the rest of the day climbing back up, or a big 30, 40 point spike to the upside, and it spends the rest of the day fading back down. One or the other. I'm not picky, right? I'm not biased. I don't care which way we go. So really something to consider there. Also keep in mind, it doesn't have to come back. So it could, spike to the upside and just spend the rest of the day running to the upside. Since we have market maker moves today, we have an additional range that we could make today. So our ADR right now is 1.4%, which is the smallest that it's been, I don't know, in a year. It feels like this. It's been a long time since we've had an ADR so low. And we're going to add on another 0.5%, which would give us 1.9. The market doesn't do 1.9. If we get that close, we're going to 2%, right? Just like we won't do 2.2. We would do 2.25. So we have the potential for a 2% move today. With that in mind, we can lay these levels out. Half the ADR would be 41.65. A full ADR would be 4,200. And yeah, I'm rounding just a little bit. So that is what we already have. But from 4,200, we want to add in this market maker move. So the easiest way to do all of this is just from where we closed, measure up 2%. $42.22. And then just do the same thing in the other direction. $40.58. It's our range for today, from 40.58 to 42.20. That's a pretty good size. And I'm not reaching here, right? I'm not just pulling these numbers out of thin air. These are defined levels that we can repeat again and again, right? It's systematic. There's history behind it. It works. We could move this far and it still wouldn't be considered an outsized move. So, and it's not one or the other. We could actually do both today. Because in a bear market, volatility is present, even if it's not gauged on, an implied volatility indicator. So we could hit both sides of that. This entire move, I still haven't even begun to measure out what an extreme move would look like, because this isn't extreme. This would just be another day at the office. So to consider what extreme would look like, one of the easiest ways to do that is just come into the analyzer and set it to a 2 standard deviation and then plot those lines out on the chart. I don't have a trade in here, so it doesn't really want to give us a time frame. Let's just throw something in there, anything in there. $40.70 to $42.19. It's a 2 standard deviation move. Yeah, interesting enough. Those are pretty close to our levels. So we ended up already drawing a 2 standard deviation move just by using the ADR and the market maker move. I've talked about confluence before. When you get the same data point from multiple sources, different sources, you're on the right track. Otherwise, you always have to be worried about multi-collinearity, which is kind of like what they talk about in politics or groupthink, right? If you only talk to people who look like you, think like you, talk like you, pretty soon you think everybody thinks the same thing you think. You're not getting a diverse opinion. If all your indicators are reading volume and telling you to go long, but none of them are reading price, you can have 9 different volume indicators that all look different. But if they're all reading volume, then you have multi-collinearity. So we got this measurement from multiple sources. And still, if we have a surprise data point, we could easily make 50% more of this higher or lower. That'd be 39.75 to the downside or 4,300 to the upside if things, if we shock and awe today. All right, so this wedge has kind of been all over the place, seeing the picture everywhere, you know, Twitter, YouTube videos. Everybody's focused on this wedge. If it was a cleanly defined rising wedge, we'd know it was supposed to break out of the bottom. And if it was a clearly defined falling wedge, we'd know it's supposed to break out of the top. But it's not that kind of wedge. So right now we don't really have a clearly defined action that it should take, right? Upside breakout, downside breakout. The one thing we know for sure is more often than not, in fact, it's very rare, price should not get to the end of this wedge, right? Where these two lines intersect. Usually it's somewhere between 65 and 85. At 85%, it will break out of this wedge up or down. We're really close to that area right now. So if we deflect here and start moving to the downside, it would be nearly impossible for it to tag the bottom and then run back up and then break out and then expand. There just wouldn't be enough time left, right? There's not enough space left in this. So if we do reject today and break the low of, say, last week's low, 40.93, it's going to pretty much give us our answer on which direction we're going to break out of this wedge. It'll be a downside breakout because there's just not enough time left rotation wise to tag the bottom of this line and then come back up. We would get too close to the end of the apex. So that's really something to consider. This is a weekly chart, by the way. So, you know, it kind of a little bit of point of view there when you get into a daily. So one of the reasons that we're focusing on this is there's really no reason to go look at any of the equities, right? It's not going to matter. Technical analysis will take a back seat to data points, right? Like pre-market economic data, CPI, and things like that. It's interesting to see that Netflix and Tesla don't have a market maker move today. It's odd. Now, since we're looking at a daily chart, these are not representing the pre-market trading activity. So yeah, we're going to start with Microsoft since it's pretty much the easiest one on the table. Microsoft and Facebook are still inside this really big green candle, and it has to resolve that, right? A bottom side breakout today would put us back in this lower zone. And the same thing with Meta. It's being controlled through this box here. That's the 4-6, April 6th. The difference between these two, though, is that Meta is still, at this point, holding above the 50% mark, whereas Microsoft failed to do that and has already tested the low once. Now, I like BABA because that same April 4 candle that we're talking about on Meta and Microsoft, it's a much smaller candle here. It's the same day. It's the same shape of a candle. It's just a much smaller version. All three of these are IX10, but BABA's got compression since it's in a smaller candle. Microsoft and Meta, not so much, right? It's a really big candle. Not really excited about the compression possibilities. Apple is completely underneath that April 4 candle. So it's already back in the box. Now the Qs, now I'm surprised. Normally, say like SPY is giving us today's candle already, right? It'll do odd things like that. Think or swim will. But still with the Qs here, nice tight range. IX10. And for SPY, it's a solid green candle. When the candle is hollow, it shows that we opened and then rallied up and closed. When it's solid green, it shows that we closed higher than the previous day's close, but that we opened and then we fell. So that's why it's solid green rather than just hollow green like all the other green candles. Yes, we got nothing. Netflix is back down inside of this box this morning. So really tight. Gapped up, fell back down yesterday. So nice compression. We'll see the follow through on that one as well. But everything's going to come down to this data point today. This is a 10-day, 30-minute volume profile with a TPO in blue on the right. We're still at the point of control. The zone that we're dealing with here is really tight. See what there was lines are at that I drew. All right, so there's the lines that I drew this morning, those market maker move lines. And here's the range of that box. Now, whenever you have a box or a range, you can use Thinkorswim's quant tool, and you can measure that range and then project that 50% and 100% to the upside and to the downside. $42.50 would be 100% of this move up, and 40.20 would be the downside move. That's not for today, by the way. I basically measured a whole week worth of data. Remember, this is a 10-day profile. And since last Tuesday, we've done all of this, a whole lot of nothing. When we're at the bottom of the box, we expect to go to the top. When we're at the top of the box, we expect to go to the bottom. We had been doing that relatively well. Only when we came down this last time and we got to this air pocket, we didn't fall through the air pocket. We actually stabilized. Then we got a double bottom. Now we've got a triple bottom, and it's still holding. And we're still not seeing really big levels of volume come in there. So whatever we're hitting, it's not liquidity. And like I talked about yesterday, my theory is that we're actually hitting something else somewhere else. So, say 10-year yields are hitting resistance at this point and pulling back, and that pops the S&P up. And then we might see trades over there if we were to go look at the data and put it on a volume profile and, really kind of examine the resistance at that point. But whatever it is, whatever market we're in correlation with, it's an inverse correlation. Something keeps saving the market right there. So breaking below 4,100 is going to be a really big deal. Just remember, wicking down isn't enough. Just because we get to that level and we wick through it and we get to the other side of it doesn't mean anything. Liquidity resides on the other side of the pivot. So price is supposed to go farther than the line you draw. Yesterday's high, low, close, a triple bottom like this, whatever your pivot point happens to be, price is not supposed to stop right on that pivot point, turn around. Once you grasp that logic, your trading will improve significantly, because you'll quit trying to trade things as if it's supposed to stop right on a dime, right at some particular level from the previous day. It's supposed to overshoot or not get there at all and miss it by a little bit because everybody front runs it. So we had some really interesting volume here Monday coming into the close. We were running up to this level here, and then we spiked up into a liquidity pool. We can see that right there. Now, if we put TPO on, it would show we didn't spend very long at this level. And yet we ended up with a significant amount of volume. So one of the reasons we want to use this thing, right? And use it combined with something like TPO. Icebergs, ceilings, previous levels, traders that didn't get their fill, which is where things like drop base rally and rally base drop come in. Speaking of this level here, right around that 4150, there's some unresolved activity here. People who were looking to get filled did not get filled. So the next time we visit this area, there's very likely going to be traders who waited, who are now going to take their opportunity to get their fill. So this kind of matches with that rally base drop. It would just be a bigger zone, right? Your distal line will still be the top, but for the proximal line, I think you'd probably be better off using the last candle before the drop for your proximal line. Which happens to be really close to that 4150. It's 3 ticks off. It's not bad. All right, the expected move for the week was 4,200 to the upside and 4076 to the downside. The lines that I drew today $42.21 to the upside is that market maker move line, and 40.58 to the downside is that market maker move line. So we're talking about expanding beyond the entire week's expected move in a single day, which is not uncommon. We've done that before. We'll certainly do it again. Here for an example, and I know how messy this looks. This was the entire trading week. I think I zoomed in on the wrong spot. Yeah, wrong spot. This is the entire trading week. And in one single day, we went from the gray line, which is Monday's open or Friday's close, excuse me, all the way to the outside of the box in a single day. And we closed below it on one Monday. So we can easily do that again, right? There's nothing that says, that it's unique. Also, we've been sideways now for days, and the longer we stay sideways, the more energy we build up. Energy is not necessarily a word we use frequently in analysis, but thanks to the RSI Laguerre, we can gauge that energy. I learned a lot about markets from that thing. One is that when a market is going sideways, it is building energy up. Two, when a market quickly reverses, it's very often building energy up. Now we're on a daily, so it takes some time, but we can see the sharp rise in energy, that it's starting to build energy back up by sitting here consolidating. So when a market's making a move, we kind of want to be able to answer that question. Is it making a move to get energy, or is it making a move burning energy off? Because when we come into resistance, if we're using energy to get to that point, we're running low on it. By the time we get there, it probably won't break through. And or if we're moving towards resistance and we're gaining energy in the move, any kind of resistance will shut it down and it won't break through resistance. You can look for this indicator on that Thinkorswim workbook Discord, and I've got a bunch of videos that I made that go with it. There are books. I didn't write them. I read them. That's why I made the videos. So if you were to, go out and search RSI Laguerre, you'll find Doc Severson. He's the guy that wrote the books. And he's really the one that put this together. It's a combination of 3 different indicators. It's got like the choppiness index, the RSI, and rocket science, rocket math, believe it or not. I can't even understand the code in this thing, and I code Thinkorswim. It really is rocket math. So that's what I got for you guys today. Watch those other markets, right? It's going to be, how does the dollar respond today? How does the 10-year yields respond to this data point? What are the bonds doing, right? And we got to kind of circle back to how the bonds are reacting in relation to the rest of the market and how yields are reacting to the rest of the market. Because for a long time, stocks and bonds over the last year kind of been moving together, right? That if yields went up or if yields went down, they affected both stocks and bonds. And we were seeing a good, clean move. And the dollar was a real impactful day-to-day candle by candle tool. It was awesome. But those days are gone. We're past that. So now the dollar is not real helpful, and stocks and bonds are back to their normal way of living, where one goes up, the other goes down. So these are going to be the tells today that kind of gives you insight on, is the breakout going to continue or not? If the data point is muddy, and I mentioned earlier that this data point isn't going to give us forward guidance the way the market really is seeking that forward guidance. We're not going to get it today. So if this data point doesn't satisfy, we could just stay in this sideways chop until tomorrow with PPI. So it doesn't owe a big move today, up or down. It could just get violent, give us a really big swing in both directions, and then we spend the rest of the day right where we are, still in this range, waiting for tomorrow. And we got all those Fed speakers today too, and oil, and Canada news. So full plate, full house. Just approach with caution. Yeah. Survive to fight another day. Everybody be careful. Have a good one. I'll see y'all tomorrow.